So good morning, friend. We'll start.
Good morning, sir. Good morning, sir.
Good morning, sir.
Yeah. Good morning. There is some little issue with my laptop, so I don't know whether I can write it properly in the code or not. Because from yesterday this problem is coming. Anyway, I'll try to fix it. Okay. So yesterday we did that problem. I think there is no doubt about how to calculate those things. Is there any doubt still? That last problem we did?
No, sir.
No problem?
No problem.
Okay. So,
No problems.
fine. Now we'll see how this gap or mismatch risk happens and how it can be managed. Okay. Suppose, say bank has, so for example, I'm telling bank has 1 lakh of deposit where bank is paying 7% per annum and the maturity is 1 year period. So basically liability is for a 1 year period, deposit is paid at 7% per annum interest and 1 lakh is the amount. And this deposit is deployed as a loan of 1 lakh rupees, say 9% of for 3 years period. So simple thing, that loan of 1 lakh for 3 years period, which is earning 9% rate of interest, is funded by a deposit of 1 lakh, which is having 7% rate of interest with maturity of 1 year period. This is the situation. That means the loan is longer maturity period, loan is having long-term maturity. This is a long-term asset which is funded by a short-term liability. Okay, so in this situation, what happens? Suppose the rate of interest on the deposit, only deposit rises to 8% in the second year, because after 1 year of the deposit, the deposit is going to renewed. Suppose it is renewed, and that at that point of time, suppose the deposit interest rises to 8%. So what will happen?
Rate of return will be less for the bank.
So first year, what is the rate of return? On the first year, what is the spread, we can say? On the first year, spread is how much? Percentage wise? 2%. But the subsequent years, subsequent 2 years, the profit are not certain because you do not know whether 7% interest will be there. If interest rate remains unchanged at 7%, then profit will continue to be at 2% margin. Subject to fact that deposit for 1 year are renewed further, our bank gets exactly same deposit for next 2 years. So here bank, so in such cases, when the asset is for a longer duration and the liability is for a short-term period, bank normally faces interest rate risk as well as funding risk. Both risks are faced by the bank. Interest risk because you never know whether this interest rate is going to change or not. If it remains same, then interest risk might not be faced. But funding risk might be faced because there might be a possibility that the depositor might take it away. Okay. Suppose this is one case. Suppose this situation is same. We keep the situation same, but this is one case. Second case, suppose bank has a deposit of 91 days. Instead of this, suppose it is 91 days. Screen not visible. Sorry.
Visible,
sir.
Because I have already shared it. Why?
No, sir, it's visible, sir. Visible.
Visible. So somebody has Lakshmi, D. Lakshmi Gurama Screen not visible. Okay. So second situation, this is second situation is this one. Suppose a bank has a deposit of 91 days with 6% per annum interest payable, and it is invested in 91 days T-bill earning say 8% interest maturing on the same day. So the bank has a matched gap here. Gap is matched here. Here gap was mismatch. Mismatch gap because 3 years and 1 year was the difference. 3-year asset, 1 year deposit. But here deposit is 91 days and the asset is also 91 days. So the bank has a matched gap and bank is not facing any interest rate risk because within 91 days nothing is changing because both are 91 days and spread is 2% again. But if the interest rate is raised by say 1 basis point, 100 basis point or 1% interest rate point during 91 days term of the deposit, then deposit will be renewed. Suppose this 91 days after this is mature or deposit is matured and suppose interest rate rises by 1% for both asset and liability during the 91 days term of the deposit. So what will happen? If both sides changes, what will happen?
No changes.
No changes. Basically, no changes. NII will be same because both sides same. It is happening same way, na? So there is no change. Okay. Now we'll see in the next thing. We'll see. Suppose instead of the T-bill of 91 days, the fund is invested in a loan of floating rate, say, which is repriced every month with an initial rate of 8%, then what will happen? Means we are having that same 91 days deposit, which is deployed or used to fund a treasury bill of 91 days. And sorry, not deposit, here also treasury bill was there, na? So bank is deposit of 91 days, it's okay. Now it says that suppose the T-bill of instead of T-bill of 91 days, so that deposit of 91 days is funded by a floating rate loan, which has got 8% interest rate, but that rate of loan is repriced every month maybe. So what will happen in this case? Such cases, what might happen? If the loan rate is changing, so what might happen?
Interest risks.
So you see, deposit is 91 days. The deposit is still 91 days. Okay. So deposit is 91 days, but the loan is, you understand, deposit remains same 91 days, but loan is 8% earning loan, but the interest rate changes every month. So think of the fact within 91 days, what will happen?
Decrease or increase?
NII will get affected.
What type of risk will be there?
Mismatch risk.
Funding
Interest
risk.
rate.
Funding risk.
Funding risk, how funding
Interest
risk is
risk
there?
will be there, sir. Interest risk.
Interest rate risk will be there because see what is happening. 91 days deposit is with you. Okay. Now this loan is there, but here loan is a floating rate of interest and priced every month. It means 91 days, within 91 days, how many times interest going to change?
3 times, sir.
3 times, minimum twice it will change. Minimum twice. It might not be 3 times also, because it might cross 90. Suppose 31 days month is there, so sometime it might cross the 90, but at least for 2 times the interest will change. Yes or no? So interest is repriced rapidly. That is, every month it is changing. Then the liabilities duration. So in such cases, what happens? We call that this is a asset sensitive position, because asset rate is changing frequently than the liability position. So these are called, this position can be told as asset sensitive position. Okay, so if the rate of interest here increasing, then what is happening? Suppose it is increasing, then what will happen to the rate of interest? What will happen to the difference between the
NII increases.
NII will increase, and if the rate of interest decreases, NII will decrease similarly. Okay.
Yes, sir.
Now alternately, if the 91 deposit of 6%, which is rate sensitive, it is used for funding towards a 10-year fixed rate of housing loan of 9.5%. What would happen, and what is this mean? Here, see, the loan interest is fixed, but the deposit interest is floating, changing. Rate sensitive is deposit. So we can say that this is a liability sensitive.
Funding risk.
So funding risk will be there definitely, but if it is going to be renewed, so it has to be renewed. Whenever it is renewed, you do not know, it might be having change of interest also. So there will be a funding risk as well as interest rate risk also. Okay, so whenever the rate of interest changes in the liability side, will affect the NII in that manner. If the rate of interest of liability falls down, then what will happen to our NII? What will happen to NII? If the rate of interest,
It's decrease.
how will it decrease?
Increase.
In the liability side, when the rate of interest falling, our spread will increase. Now NII will increase.
Increase. Yes.
Conversely, if the rate of interest is going up, it will be decrease. Okay? Yes or no? Why I am telling that? See, asset sensitive, when the position is asset sensitive, if the rate increases, what is happening? When the position is asset sensitive,
NII increases.
and when the rate of interest is falling down, NII will falls down.
Will decrease. Yeah.
Here, if the rate of interest increases in this as liability sensitive thing, when the rate of interest is
Decrease.
NII decrease.
when the NII decrease, and when the rate of interest is falling, NII is increasing. So these are the two different situations which happens. Clear? So you have to just, I am just revising you. Yesterday we did it, just telling you the position, how it will be happening. Okay. So this gap analysis we have done. So gap analysis is the method to measure bank's interest rate risk. So basically it is, first you have to find the repricing gap, which is interest sensitive asset minus interest sensitive liability. It is about the amount of quantum of the asset and liability. It is not about the rate of interest. So gap equal to that amount. So 300 is the asset, 200 is the liability. So 100 is our gap. And with that gap, we are multiplying the assumed change of interest rate, so that becomes the approximate change in the NII whenever there is a change which is happening in both asset side and liability side uniformly. And we have done yesterday, when it is not uniform, different magnitude, it is changing in all the asset and liability, then what is the impact? And we have also, I have also told you to, at that point of time, you have to logically think that which side is affecting. Okay. So now see, this is the one of the some position of the bank. So 1 day to 5 years position is given for asset liability, where gap and cumulative gap is given. Okay. Now, can you, with this thing, can you tell me what is the position of the bank in a just simple thing? What is the position of bank during this 5-year period? Just tell me what is the position in the short-term period and long-term period. Short-term period is say up to 1 year, long-term is above 1 year. What is about position of the asset and liability? Suppose you are in the asset liability management department, what do you see this?
Short term bank has the large gap. In a long term,
Loss of 550 short term.
Liquidity risk.
Good. So it means that in short-term period, bank has negative gap, but in the long-term period, bank has positive gap. It is shown by this. Short-term period means up to 3 years period minus 300 is there, gap is, and up to 5 years, above 5 years period, bank has a positive 650. Okay. So if you take into the consideration the cumulative gap of 1 year period, so 1 year period is up to short term period. What is the position? Position is that we have a negative gap of 550. Okay. So in such cases, in this negative gap, say one short term period, you take the cumulative gap thing. In such cases, suppose this is the cumulative gap of 1 year is a 550. So if the rate of interest in short term interest rate of the bank increases by 1%. So what will happen to the net interest, net NII of the bank? What will happen to the NII?
Decrease.
NII is reduced. By what? Suppose 1% change is there. How much it will be? If there is a change of 1%, for it's a decrease by, so rate of short-term interest rate is increased by 1%, then NIM is going to fall by how much?
550.
5.5.
5.5 crore. So suppose these are suppose in the crore, so you can say that this multiplied by 1%. So 5.5 crore will be the impact. Okay. Suppose when RSA minus RSL, or suppose this is greater than 0, that means this is a rate sensitive asset which is more than the rate sensitive liability. There is a positive gap. So at that point of time, if rate of interest falls, then what will happen to NII?
Negative. Decrease.
So basically it will be decrease. Okay. So when NIM is reduced, so the asset, so what to do at that position, what bank should be doing to protect its NII, what bank can do? What is the position bank can do during that place when RSA is greater than RSL and the rate of interest falls, when our NII is going to fall down also? So what the bank can do?
We will try to increase the liabilities.
Increase the liability? How?
Yes, sir.
Increase the liability or no?
Increase the
I
asset.
didn't get it. Huh?
Increase the assets.
Increase the assets.
Increase the asset means asset amount, or what you are telling?
Asset amounts.
Amount. Asset is, say, I told you here, asset is more than liability. Asset is more than liability. This position is positive. So RSA is greater than RSL. So rate of interest falling, NIM is reducing. That means what should be done to
Rate
protect
of
the
interest.
NII?
Rate of interest of the assets to be increased.
Okay, assets to be increased, or you are telling, see, okay, fine, assets to be
Rate of
increased.
Rate of interest
Either,
increasing asset.
suppose the rate
Or
of interest fall, I am
or-
telling about rate of interest falling. Rate of interest is falling down.
Quantity of assets should be increased.
Quantity of assets should be increased. So here already
no.
increased, na? Here it is already increased only.
Yes, sir.
Is the
decreasing
rate of interest
in
increasing?
liability.
No, sir. Assets to be decreased, not interest. Amount of the assets to be decreased.
Rate of interest of liability to be decreased.
Rate of, so you are talking about, if you are protecting the NII, then definitely we have to do something with the rate of interest. Rate of interest of the liability, if you decrease, then definitely it will be a good thing to protect your NII. Or suppose we are talking about the funding risk, or say how to protect this, we can do that. The assets, so this is a position I am talking about, say short-term position. So assets that would mature need to be reinvested at a higher rate, right? Yes or no? Suppose some assets will be given more. You are telling, somebody is telling assets should be more. More means more asset if you are deploying, then definitely that has to be reinvested. So if the assets are maturing or new assets are being created, then they should be having a rate of interest which is much higher than the existing rate. That then only you can protect the. Suppose the reverse position is that when RSA is less than the RSL. In that case, suppose RSL is greater. Now liability side is greater. So what will happen? If liability is more and interest rate is coming down, then what will happen? NII
increase.
NII
Positive.
still for
Positive.
Increase.
because
Decrease.
RSL is more. So no, how? RSL is more. So if the rate interest falling down, so you are still confused about this concept. So that's why I'm repeating all these things. RSL is more than RSA, interest falls down. So our NIA will be increased or decrease.
Increase, sir.
Increase, sir.
Increase.
Increase because liability is more than the asset and rate of interest falling. So we'll have more saving, because we have to pay lesser amount to the depositor. Okay. So this is what the positions. I'm just repeating this for you because I think some people are still confused about this concept. Just think about what is happening to our earning side in the asset and what is happening to the payment side of liability. How it is impacting due to change of interest. When asset is more, liability is less, interest falls down. NII also reduces. This reverse position is when liability is more and then asset and interest rises. So you have to pay more to the liability. So NII will decrease. When such cases, asset is more, liability is less, rate of interest goes up. So we have an increase in NII. When liability is more, asset is less, interest goes up, we have a reduction in NII. Okay? So these things you should remember and should apply logically. Now the next thing, now sometimes this question is asked, how to calculate the different things which are to calculate. Normally you have to calculate the economic equity value, the last one, fifth one. So sometime a problem comes, calculate the economic equity value. So these are the formula you have to remember. First, we have to calculate the sum of information you will be given. So you will be given with information like your RSL how much, RSA how much. So here your RSA are there, RSA and the rate sensitive liability and the rate sensitive asset is given. Then you will be given with what is the modified duration gap of the RSA and what is the modified duration gap of the RSL. So basically, DA is the modified duration of RSA and DL is the modified duration of RSL. So both will be given. So 1, 2, 3, 4 figures are given. Then you will be also given with the net worth or equity or the capital held by the bank. So it can be net worth, it can be equity, or it can be shown as capital. So if you have these figures with you, then you have to calculate the first one. It's called calculated weight. Calculated weight formula is RSL divided by RSA. So simply divide the RSL with the RSA. So whatever the number comes, that is the calculated weight. Now, see, modified duration gap have to be calculated. Sorry, that has to be calculated with the formula DA minus W into DL. Okay, so DA is given in the question, DL is given. Now W we have calculated here. So if you apply this formula DA minus W into DL, we get this modified duration gap. Okay, then you have to calculate the leverage ratio. Leverage ratio is the RSA figure is given, equity figure is given. So RSA divided by equity equal to the leverage ratio. Now you have to find out the modified duration of equity. That formula is DGAP, that is the second one we have calculated, modified duration gap, into the leverage ratio, the third one. So 2 multiplied by 3 is the modified duration of equity. Now to find out the economic equity value, the question will be given. So there is a change of interest by this BPS, 300 BPS, 400 BPS, 500 BPS. Then what is the economic equity value? So basically, modified duration of equity we have calculated here in number 4. We have to multiply with that with the change in rate of interest what is given in the question. Say 300 BPS, 400 BPS. So just multiply that, you will get that economic equity value. So how this is to be done, just you can do that. The figures are given. So please do that and let me know what is the economic equity value with the question given as for a 200 BPS change, what is the rate shock or what is the economic equity value of that? Can you do this? So here net worth is given, RSA is given, RSL is given, DA is given, DL is given. I've given you the formula. If you want to write down for, do you want to write down formula? Take the screenshot. I can give you that slide again. Or if the book is in front of you, you can easily manage.
So that slide, sir.
Sir, question please.
If somebody has answered, W is 1.09.
1.08.
1.08 or 1.09. Okay, fine. 1.088 means 1.09. Fine. Next, find the DGAP.
0.34, sir.
Point
34.
DA is how much? 1.84 minus
0.42.
0.34. It will not be there, I think. I think it
Then
will be 0.4, 0.41 or 42, whatever you take. So 0.42 will 41 or 42 will be correct. Okay. Please do that again. Who told that 0.34? 1.84 minus W is how much? 1.09 into 1.31. Do it. So it will be 0.41 or 42. Okay, fine. 42. Now do the leverage ratio. RSA divided by your equity.
14.87.
14.87. Then calculate the modified duration of equity. So 14.87 multiplied by your DGAP. DGAP was how much? 0.41 or 42.
6.24, sir.
6.24.
6.24.
Okay, fine. 6.24. So for 200 BPS change, what is the economic equity value or what is the rate shock? Simply it is asking 200 BPS change. It is not telling you that how this 200 BPS is increasing or decreasing. So simply you multiply that, na? Your
1249.25.
Pardon?
1249.25.
1249.
Yes, sir.
1248, sir.
12 divided by 100. So 12 point something it should come.
12.49.
Simply multiply 12.49. Okay. So 12.49 is the your economic equity value, or it is called also rate shock. So for 2% or 200 BPS change, the economic equity value will change by 12 point whatever 49% or whatever. Okay. So it means that if there is a decrease in BPS, economic equity value will drop. If there is an increase in BPS, economic equity value will increase. Okay. So this type of questions are coming. One question might come. So you have to remember these formulas.
Sir, last one, sir. Sir, last one. Not good.
Last one formula is economic equity value formula equal to your modified duration of equity multiplied by rate of change in BPS. Or you simply multiply by your 2%. 200 BPS means 2%. So your modified duration of equity, how much you got? 6.24, na?
Yes, sir.
Yes, sir. 6.24.
6.24 multiplied by, simply multiplied by 2. So 12.48. 12.48%. Simply you multiply it by 2. 6.24 into 2 equal to 12.48. That is, you can say 12.48% decrease or increase according to the change of BPS.
Sir, I didn't get modified duration of equity, sir.
Modified duration of equity equal to your 2 and 3. DGAP multiplied by 3 leverage ratio. What is your DGAP? How much DGAP you got? 0.41 or 42?
42,
Whatever
sir.
you are getting. 42. 42. Leverage ratio is how much?
14.87, sir.
Multiply these two.
6.24.
6.24 is your modified duration of equity. And the last formula is modified duration of equity multiplied by the rate change.
12.48, sir.
12.48 is the change which might happen. So if the change of BPS is increased, so you have 12.4948 or 49 is increased. If there is a decrease, it is a decrease. So what is increasing, decreasing? Your economic equity value is increasing or decreasing. Okay. Now, how this liquidity risk is measured? Sometimes questions are how many methods are there to manage this liquidity risk? So basically there are two methods. One is called stock approach, second is called flow approach. So there is a stock approach method, flow approach method. So remember these two methods and remember that only two methods are there to measure or manage the liquidity risk. Okay. Stock approach method is what? Stock approach is based on the level of asset and liabilities as well as off-balance sheet exposure on a particular debt. That means how much stock of asset you are having, that's the quantity of asset, and what is the quantity of liability, as well as how much of the off-balance sheet exposure you are having on a particular debt. So all the quantum of asset, liability, and balance sheet, off-balance sheet exposure like bank guarantee LC, on a particular debt, how much stock is there, those stocks are measured and the gap is found out. So that gap will tell you the liquidity position. So that is called stock approach. Okay. What is your stock of asset and liability? Basically, it is about asset and liability. You have to take care of the off-balance sheet exposure also, because you never know on what particular day this off-balance sheet exposure will be becoming a funded exposure. So you have to create a loan. So when you are creating a loan, definitely fund is required. So that might also increase your liquidity risk. So you have to take all the stock of asset, liability, as well as your balance sheets, of balance sheet items. Secondly, the flow approach is that it has got three dimensions. This is got simply you have to take the quantum of asset, liability, and of balance sheet, and you can plot that and you say that what is my gap. After 3 months, what will be gap? After 1 year, what will be gap? Simple thing. Now, flow approach is three dimensions, means measuring and managing. Here, managing the funding requirement is also one of the methods. Means you can measure through the stock approach. After that, how to manage the funding requirement. Whether you can approach to your depositor, some of the deposits are there, they are corporates or something, they can help you, give you bulk amount of deposit on that day. Or do you have a market access? Means in the market you have some access to some of the banks and financial institutions where you can easily get the availability of the funds. And as I told you, when you are going to borrow funds from the market, so you have to have a good rapport with such bank and financial institution that not only quickly you get the fund on the same day you want fund, but also that has to be with a reasonable rate of interest. Because if the interest rates are high, then again your NII is going to decrease. So that management of that market access and rapport with any of the thing means you have some arrangement with some of the banks, with your liaison with the bank, so that at a very short disposal you can avail those borrowings, and their borrowings are not that costly. So that method of maintaining that is called a contingent, or you have a contingent plan. Means you have some liquid assets which are available with you. You can easily dispose of liquid assets so to get the fund which is required. So these are the things to be done on flow approach. How the flow of the money, cash flow of the bank, inflow and outflow will be managed. So for that, you need that funding requirement. So when you know the gap, knowing the gap, measuring the gap is the stock approach. after knowing the gap, when you calculate the gap and manage the funding requirement, that is about the flow approach. Okay, so this is only thing about stock approach and flow approach. Okay. Now, some of the ratios are taken into consideration to decide the liquid position of the bank under the stock approach. Stock approach means quantum of liability and asset we are talking. So, while doing that, we can take some of the ratios and see the position of the bank. Say, each ratio you see and let me know if this ratio is higher the ratio is good for the bank or the lower ratio is good for the bank as far as the liquidity position is concerned. So first ratio is core deposit to total asset. Whether banks this ratio should be a higher ratio or lower ratio, and we are talking about the only liquidity position of them. Can anybody tell it? Core
Higher
deposit to
Sir,
core
high.
deposit high. Okay, you are telling higher ratio is good. Why higher ratio is good?
We'll have sufficient.
The sufficient deposit to back the asset.
Sufficient deposit will be there for if you sufficient deposit for 5 days is there. What is the utility? So here
Position is there.
higher means definitely core deposit is more than total asset. Higher ratio, definitely it is more than total asset. That means higher. But thing is that what does you mean by core deposit? What does it suggest? Core deposit, what is the advantage? Tell me,
CASA.
what is that? Huh?
CASA.
CASA is both core and volatile together. What here only core deposit you are telling. Here it is written core deposit only. So what is the feature of main strong feature of core deposit?
Invest in more assets.
Sir, available for long term.
Capital.
That long time. These are stable source of fund. Yesterday I told you that savings and current deposits are divided into two categories. One is called volatile, one is called core. So, volatile deposits are kept under which maturity ladder? Yesterday we have discussed 1 to 14. And core are kept under which maturity ladder?
1 to 3.
1 to 3 years. So, if the deposit are remaining from 1 to 3 years is good for the bank or not? So that is what I mean. Why core deposit are so significant? Because core deposit are stable source of liquidity. At least for a period of 1 year, you should not be worried. So higher core deposit to total asset ratio is better for the bank. Next, second one is net loans to total deposit.
Sir,
So,
here is
suppose-
loans availed or given.
Availed means bank avails loan or bank gives loan. You are taking the liquid position. Total loan figure, total deposit figure. So if you are telling about loan is obtained, then deposit is given. Bank is having this loan and bank is having this deposit. Obviously, bank is giving loan. Okay. So take total loans to total deposit. Not you are confused about net loan. total loan to total deposit. Here we are talking about liquidity position only. We are not talking about any profitability, anything. We are seeing the liquidity position of the bank. That's why the question is whether
DSCR.
loans should. Huh?
DSCR, debt service coverage ratio.
Why that is coming here? Why that debt service coverage ratio is coming? You are in a credit management class or asset liability management class. DSCR is not relevant to anything here.
But lower ratio.
Why lower ratio? You tell me.
No, because loans are given against the total deposit. So,
The total deposits are higher against compared to net loans, so liquidity will be at a much better position.
Okay.
if loans are higher than total deposit, but in case of higher ratio, then it will be the liquidity position will not be achievable fast. And in case if it is higher, then good liquidity position will be there for bank.
So if the ratio is nearing to 1, if the ratio is nearing to 1, then it is more. Shows that it has more liquidity.
How? No, that you are talking about profitability. If it is 1, profit will be more. 100 rupees loan, 100 deposit, then you are talking about profitability. But where is the liquidity? If 100 rupees loan or 100 rupees deposit you are telling, then only this will be 1, na? Okay. Suppose 100 rupees is loan and 100 is deposit, where is the liquidity? How the liquidity? See, 100 is, if loan is 100 and deposit is say 101, then your liquidity position is good or bad?
Good.
Good. So always deposit liability should be. We are not talking about profitability. That's why I am repeating. We are talking about liquidity position. So if deposits are more amount than the loan amount, then definitely that position is better. So in this case, what should be the ratio? Ratio should be higher. Ratio should be higher or lower ratio. Because simple thing, logic is that loans are considered as less liquid asset. So that's why lower ratio is better. Okay. Now come to the third one. Time deposit to total deposit.
Higher is good, sir.
Very good. Because time deposit are more stable deposit than your savings and current deposit. Because those are correct. The third one, volatile liabilities to total asset.
Should be lower, sir.
Volatile liability.
Lower, sir.
No, sir, no.
Lower.
Lower.
Think again and tell me.
Since it is liabilities, it should be higher.
Volatile liability to total asset.
Higher, sir, higher.
Higher, sir.
Given this second position I have given. So basically, volatile liability means when you are having CASA, the 1 to 14 days volatile savings and current account, or you have your borrowings, market borrowings will be for short-term period. So basically, in such cases, liquid position will be high. Liquid position will be better if the ratio is high only. Okay. That is what you are telling, right?
Sir, volatile liabilities to total assets, it should be low, no, sir. Because liability side.
No, sir. It should be higher because volatile liabilities are volatile in nature. Short term. It is short term duration. So from liquidity point of view, if volatile liabilities are more compared to total assets, then it will be good.
So you are telling the ratio should be low or higher?
Low. It should be low, sir.
Because see certain things are there which we normally get very confused. Volatile liabilities, we are talking about liquidity position. Volatile liabilities means normally we take the borrowings. We will take the case of borrowings. This volatile of say savings and current are very less, 10 to 15%, so we will not consider. Suppose volatile liability means market borrowings we are doing. So volatile, they are volatile in the nature, means for very short term, maybe 7 days or within 14 days you are borrowing. So every time you are borrowing, so if that is becoming volatile in nature, every time you need to borrow, that means higher proportion of volatile liabilities will be a problem for the bank. Because of that only your liquidity position is not good, that's why borrowing. So higher position means your higher borrowings are there. Lower ratio means lower borrowing is there. So lower ratio is better for the bank to have a lower liquidity position. Okay. Now talk about the next one. Short-term liabilities to liquidate asset. Short-term liabilities to liquid assets.
Low, sir.
So short-term liabilities and liquid asset. Why it is low? Why it should be low?
The higher liquid assets will give more liquidity.
So short-term liabilities should liquid assets also short-term assets. Short-term assets should be more than this short-term liability.
Short-term liabilities to liquid asset, whether low ratio, you are telling higher ratio is better.
Yes, low, sir. Low.
Low.
So high is better because the organization is capable of
Liability.
maintaining the liquidity problem.
Short-term liabilities means, see, short-term means normally how much? Short-term, as I told you, all the deposits are less than 1 year.
1 year.
Less than 1 year period. Okay, short-term. 1 year, less than 1 year period, your deposits and liquid assets are there, which might be within 1 year period, or it might be little bit more than 1 year period that can be liquidated. So if you have invested some marketable securities and that can be liquidated at any point of time, those are called liquid assets. Or cash is there. Most liquid asset is there. So what the assets are also short term in nature and liabilities are short term in nature. So which we are thinking about the liquidity position. So liabilities are, see, assets are liquid, but you don't see, assets are owned by you. Assets are your own. You are not going to give it back. It will be renewed or thing whatever after short term, it will be with you. But these liabilities are short term means after this period is over, you need to renew it or the people will be taking the deposit. So in that case, what will happen? Liquidity problem will be there. When they take the deposit, assets are not going to be taken by somebody. Assets are yours only. When assets are maturing, the payment will be coming. When the payment comes means that is a liquidity problem is solved. So short-term liability means normally these are the liabilities which are to be redeemed at the earliest. So when the redemption of liability happens in earliest manner, so it is a liquidity crisis for the bank. So it has to be always lower ratio of short-term liability to liquid asset is good as far as liquidity position is concerned. Okay. Now next is liquid asset to total asset.
Lower.
Obviously lower, no sir.
How lower by liquid position you are telling. So total
assets higher.
so if you keep more
Higher,
fixed
sir.
asset, fixed asset ज़्यादा है. If your asset fixed asset is more, then your liquid asset, what will happen to fixed asset? When you are going to sell, you cannot sell. It will take time. When you are going to sell, the price will be always low. So short liquid asset always, if it is more, then it is good. So if this ratio is high, then it is good for the bank. Liquid, more liquid. We are talking about liquidity risk. So high ratio is good for the bank. Next one, you decide short term liabilities to
So here
total
total
asset.
assets means the total fixed assets
No.
only, not including the total asset. I mean liquid assets.
All asset, total asset mean whatever the balance sheet you are showing total asset. Liquid asset means cash and marketable securities, which are the loans which are maturing within a period of 1 year, we will get payment. So all the inflow
So then
will come
liquid
there.
assets also include in total assets, liquid assets also including no sir. So that obviously
Yes,
it will be that
yes.
for example, if liquid asset is 10 rupees, the total asset is 100 rupees. This 10 is to 100, no sir.
See,
It is
suppose
not fixed.
liquid, see, total asset is 100. Okay. Total asset is 100, out of which
Yes, sir.
30 is the liquid asset. What is the ratio?
3:10, sir.
3:10.
Yes. 3 liquid assets, 10.
Okay, fine. So in that case, that is the case, 3:10. Whether 5:10 is good or 6:10 is good, then the 3:10.
5 or 6:10 is good.
So that is the question. Higher ratio is 5:2 or 6:10 is better
Okay,
than 3:10. Okay.
Okay, in that time. Okay, sir.
Now the short-term liabilities to total asset.
Lower.
Low.
High, sir.
Lower, sir.
Higher, higher, sir, higher.
Lower, sir.
So assets are, they are our thing. We are not going to give it to somebody. It is their inflow will be coming. So asset, when you're thinking that total asset is there, means some of the assets are going to
अभी तो on है.
liabilities are going to be paid in short term. So frequency of payment for the liabilities means going out. Cash outflow is more here. Assets are normally cash inflow as this total asset is concerned. Okay. So what is the better position as far as liquidity is concerned?
Lower.
Lower ratio. So always think about that. Liquidity, lower short-term liabilities ratio with the total asset is better or desirable. Now tell me, what about the prime asset to total asset?
Higher.
Why?
Prime assets will be the, I mean, that is also the like core assets only. Prime assets also core assets only. So core assets should be higher.
What is the, what, can you give me the example of prime asset? Any example of prime asset? You are telling core asset. So what is the example of prime asset?
Balance in other bank balance in other banks.
Reserves.
Okay. Anybody else? What is a prime asset?
Long-term loans. Long-term loans.
Long-term loans are primary asset. Prime
Capital.
asset means, yeah. What do you mean by prime asset?
which is earning higher interest rate of interest.
Those are prime asset. Prime asset you have forgotten in JIB accountancy, it might be told. Prime asset is cash balance you are maintaining. That is the prime asset. Okay. So forget about all other things. Prime asset means how much cash you are holding. So if your prime asset as to total asset ratio is higher is good or lower is good?
Higher is good. Higher is good.
Higher.
Lower
Because
is good.
how lower is good?
That
Again,
cash will not earn any profit, no, sir.
See, I have told you beginning we are talking about liquidity position. We are not talking about profitability. From the beginning, I have told 4 times why you are going to profitability. Here we are concerned about liquidity. Profitability we are not talking here. That's why I have underlined that liquidity position in this slide. Okay. All ratios are under stock approach where we are assessing the liquidity position. We are not thinking about the profitability. If you talk about the profitability, most of the ratios will not qualify. Okay. So prime asset means immediate assets are there. Immediate liquidity is there. Cash is there. You can easily fund it. Then last one is your market liabilities to total asset. Market liability means your borrowings, market borrowing, interbank borrowing, which are repayable within a short. Normally, market liability means you cannot borrow more than 1 year period. So, what will be the effect?
Lower. Low.
So, lower the ratio, it is better. Okay. Why I am discussing all the thing? Because sometimes the questions are asked on liquidity position. Which of these ratios, one of these ratio is not favorable for liquidity position. So 3 ratios, 4 ratio given, 3 ratio you have to see they are favorable for liquidity, 1 ratio is unfavorable. So wherever we found those lower ratio is good, then those are unfavorable ratio. So you have to check that out. So you have to just assess the position. What is this is about liquidity. Do not see, normally always we think about profitability, but whenever liquidity is, we are talking about liquidity, profitability is not our concern at all. Here profitability is not the question. We are just want to maintain the liquidity position of the bank. Okay. So profitability, you should forget about profitability. You have to think about the liquidity only. Okay. Now, next is how this structural liquidity gap method is to be done and prepared. My this pen and thing is not working and my laptop is giving some problem. So I'm sorry for that. I will be only able to write a few things only. So next thing you have to do it carefully. I will be guiding you. Okay. So basically, under this flow approach, this structural liquidity gap report is prepared by the bank. And as I have already told you, the structural report gap report has to be prepared bank every day. They have to do it, and every 15 days they have to submit it to RBI. So how this measurement is done through flow approach? First thing is that you have to prepare the structural liquidity gap. Okay. Then the net funding requirement has to be assessed based on the residual maturities. So you have 10 maturity ladders. According to that, you will place all your inflow and outflow of the fund. So you have your total inflow and you have total outflow. Then finally, you find the gap between this inflow and outflow. So you have found the gap. Then you have to calculate the cumulative gap. Then cumulative gap. So this cumulative gap, whatever the cumulative gap and gap position is telling you in the each of the time band or time bucket, then you will take a final decision that whether cash is to be or liquidity is to be there, arrange that, and if that has to be arranged, how you are going to arrange that. So that is the thing. So here I am showing you the structural liquidity gap report or statement. Everything I have done. So only thing is that the questions, how question might be given to you without the cumulative gap thing. So you have to take care of that. So this is the structural liquidity statement or structural liquidity gap statement. So here you'll find that the first highlighted yellow line is the total outflow of the bank for all 10 up to this one 10 maturity gap. So from tomorrow to more than 5 years, all the figures are given. Okay, just ignore this 200. This is a type mistake. This is a typing mistake. So ignore this one. 200 is not there. Okay. So now, similarly, these are the outflow. Outflow means some of the fixed interest liabilities are there. Some of the floating interest liabilities are, and other liabilities are there. So these are the outflows of this yellow line first. Then your inflows are there. Inflow, these are different types of things are given, and total inflow is given as the second yellow band. Now, the difference between outflow and inflow are taken in the gap. This is the gap. Okay. Now, cumulative gap is the previous gap with added to the cumulative gap, you add the previous gap, the next gap you become. So 100 was the first gap. So cumulative gap becomes 100 because there is nothing here, nil. So 100, 100. Now next time band, 100 minus 100 is the gap. So cumulative gap becomes when you add these together, these two. Minus 100 in this minus 100, 200. Here the gap becomes positive. So 8 to 14 days positive. So previous gap was minus 200, here is plus 100. So our cumulative gap becomes minus 100. Like this, it has been plotted. Is there any doubt about this gap and cumulative gap?
No, sir.
No, sir.
No? Okay. So this, I told you, this report is compulsory for all banks. This report has to be submitted to RBI by banks on first and third Wednesday of each month. Okay. Now, this gap you have to sometimes up to total. So basically, question will be asked about the 4 gap only. They will not give you so long question because RBI is concerned about the liquidity position of short-term nature up to 28 days or up to 1 month period. So these 4 things will be given to you with total outflow and total inflow. Next, you have to find the gap and cumulative gap. When you find this cumulative gap and gap, then you have to calculate what is the cumulative gap to total outflow percentage. Can you calculate and tell me whether my figure of minus 14.29 is correct?
Yes, sir. Correct, sir.
Correct. Second one also you check whether it is correct. All 4 you see whether I have done it correctly or not.
Second also correct, sir.
Correct. So I think third and fourth
Third
will be
also
also
correct, sir.
correct. Okay, fine.
Third also
I
correct.
think okay, fine. Now the question will be asked when this you have calculated, these are the cumulative gap to total outflow. So question will be asked that how much this cumulative gap to total outflow percent is exceeding by the RBI's requirement. How much it is exceeding? What is the RBI prescription for first day?
5%.
5%. So it is how much this is?
14%.
14.29%. So what is the excess?
9.29.
9.29. So simply, if the question will ask, what is the position of first day as far as the RBI prescription is concerned? So you can say that it has exceeded limit. The question might be asked, how much it has exceeded limit? So required is 5%, but you have 9.2%. 9.29%, that 14.29. So that means 9.29 is the exit. Okay. Suppose you have calculated all this thing and a question might be asked, which maturity ladder out of these four satisfies or complies the RBI's prescription of liquidity under structural liquidity statement? Which one is okay? Fourth one is okay. So first, second, third are not okay. Clear? Means first one is 5%, but you have 14. Second one is 15, so it is 30. Third one is second one is 10, you have 30. Second one is 15, you have 18. So all three are excess. Last one is 20, but you have only 14. So this one is within the limit. Okay. So basically, bank requires to make arrangement of the funds for these three immediately. This is not required to be made. Okay.
So here minus sign makes no difference.
అవును దీనికి డబ్బులు ఎప్పుడు వస్తున్నారు
It's minus
అంటే
14.
ఎక్కడ 2
It
lakhs
makes no
తీసుకున్నాడు కదా
difference.
అయితే అలాగే వద్దు నాన్న అలా అయితే ఎందుకు నాకు ఆ డబ్బులు ముందే ఇచ్చేద్దాం ముందు ఇచ్చేస్తే
Rajesh sir, please mute sir.
ఎందుకంటే పాల్కి ఎవరు ఒప్పుకోరు క్యాష్ తీసుకుంటారు ఎవరైనా
Rajesh sir.
రాదు
Sir,
కాదు
please mute
దీనికి ఆ డబ్బులు
everyone.
రోజు డబ్బులు ఇచ్చేయాలి
Mr. Rajesh, your dialogue delivery is over. Mr. Rajesh, I am talking to you. If you are ready with the class, if you see, it is possible that you may have some need to talk to somebody. There is no issue with that, but that is a simple button is there. You press that button, it will be unmuting your mic. Okay. Next time, please do that.
Yes.
So this somebody was asking something, minus sign.
Yes, sir.
Minus means what? You are exceeding. Plus means you are not exceeding. So I could have given plus sign somewhere. Suppose here everything is minus, na? Because
Yes.
it is coming is minus only. Plus means your inflow is much more. Whenever inflow is much more than that, then it will be a plus.
Yes.
Okay. So definitely your question I understand, but minus is given for the fact that your liquidity position as per the requirement, it is exceeding. Here 700 is outflow, inflow is 600. So definitely position is minus, negative gap. Yeah?
Yes.
Okay. Yes. So here only, see, as far as the only gap is concerned, we can say that plus or minus something. But here, if you take the cumulative gap, since all are in minus, so that's why it is written in minus. Only here the cumulative gap at the 5-year period, you see, this is the only plus. This is the only plus. So here, whatever the thing will come, this will be a plus sign. Okay.
Okay, sir.
In gap, when you come to the gap only, this, if you take the gap as percentage from gap to cash outflow, then this will be a plus. This will be a plus. This, wherever this green are there, those things will be plus one.
Yes.
Okay.
Yes, sir. Thank you.
And this position you can see, the bank can easily see that. Ratna is asking, sir, how you got the outflow percentage? Outflow percentage means cumulative cash is 100, outflow is 700. So 100 divided by 700 into 100, that is the percentage. It is the percentage of cumulative gap to total outflow you are calculating. To cumulative gap here is 100 divided by total outflow is 700. So you calculate 100 divided by 700 into 100. That is the percentage. Ratna, are you okay with this? You have okay, fine. Now here we can see another thing that see the gaps are here. So only the positive gap is happening in the 8 and 14 days and say 3 months to 6 months, 1 year to 3 year, 3 year to 5 year, and 5 year to above 5 year. That means bank has, there is no liquidity problem as far as the long-term period is concerned. Because up to this short-term period only, up to 1 year, there is liquidity problem because every day you see out of 3, 4, 5, 6, 7 bands, we have only 2 positive. Rest are totally negative. So from this structural liquidity report, bank can easily assess their liquidity position and make arrangement for the funding risk to or come out of the liquidity risk or funding risk. Okay? Is it clear? If such questions come, you can easily answer.
Yes,
I
sir.
want some. Okay? No problem. So this type of question will be one question will come. So you have to answer those questions. Clear? If you have any doubt, you ask me now. You have to remember this only. The formula is the RBI says the cumulative gap to total cash outflow percentage should not exceed by 5% for the first day, 10% for second day, the second band, 15% for the third band, and 20% for the fourth band. That much you have to remember. If you remember that, you can calculate that one and find out what is the question asked. Okay, so the closer a large gap, it is very difficult to offset that gap. So closer is the large gap. So 300 is the maximum gap, which is 29 days to 3 month period bank is having. So you have only 30 days period to address this issue of 300. So here 300 is also there, 250 is also there. So basically they are within a period of 1 year, the problems are there. So after 30 days is happening. So bank has 30 days time to address this gap. How you are going to manage this gap? Because your outflow are more. So you need this much of money. Already only inflow is 950. So rest amount you have to manage. If you have managed this 50, then or this 150 has been managed for 30 days, only 150 needs to be managed. Total 300 need not be managed. So this is what the bank's ALM department every day they do it and find out the position every day. Okay. Now we go to the interest rate risk management. Percentage of 29 days to 3 months. Why you want? When I am telling that up to this you do, why should you do for 29 days? RBI has given for only 4. I have told you so many times that RBI is concerned about the first 4 bucket only. Why you want Prashant Sinde? Why you want 29 days? Okay, you don't require it. When it is not required, why you are breaking your head? I don't understand. It is not required. RBI is given for the first only. This cap has been given for first 4 only. RBI is not concerned about 29 days. So you forget about those things. It did not require. That's why I have not done it. If RBI should have told about do up to 1 year, then I would have also done that. Okay. It is required for the first 4 buckets only. Now interest rate risk. Next is interest rate. Means already we have done that interest thing in here. our exercise that day. So interest rate risk arises when the interest earnings are not enough to set up the interest payment. So means our asset, whatever amount are earned by the asset, it is not enough to pay to the deposit or borrowing during a given period of time, which might happen due to change in the rate of interest in the market. Suppose, say this condition, suppose bank has mobilized 100 crore deposit with average maturity of 6 months at 5% interest. So your deposit liability side is 100 crore for 6 month period, you are paying 5% interest. If the bank invests that 100 crore amount in a fixed interest loan, which are repayable for a period after 5 years, meaning loan period is 5 years, and bank is earning 7% interest, then what is the situation? So in this case, what is the situation? Can you tell me? Simple thing. Simple thing.
Interest rate risk is there.
Okay. Interest rates is there. So, okay, that is there, but within this 6 months period, what is
We can repay, sir,
question?
because we are getting excess interest, 7% per annum.
So, where? So basically, deposit is going to mature after 6 months and need to be renewed or replaced or recycled at the whatever rate it will be. Okay.
Yeah.
So for the 6 month, we have no problem because deposit is with us and loan is with us, and we have how much in a spread? How much is the spread?
2%.
2%. That means 2% spread means what will be our profit for that 6 month period within that year? We have booked a profit of how much?
2%.
2%.
In amount. In amount, can you tell?
2 lakhs.
How 2 lakhs?
Sorry, sir, 1 lakh, sir. It is for 6 months only.
No, whatever it may be, 6 months only. But for 6 months, how much is the spread? Whatever your amount you spread means spread is 2%. You are not charged 2% of what?
2% of 100 crore.
100
crore. So that is
So
2 crore per annum.
2 crores, sir.
So
2 crores.
1 crore for 6 months.
Okay,
1
1 crore
crore.
per 6 months. Okay, fine. So your earning is fine, no problem. So after 6 months only, you will have a problem. We are not concerned here about the liquidity because we are doing interest risk management. So problem will come, interest risk will be faced by the bank if the interest of the liability increases. Yes or no? If the interest of liability increases, this 5% increases, then we have an interest risk problem. If 5% remains same or it goes down, there is no problem. Okay. So basically, suppose after 6 month period, the rate of deposit is on the rise. So rate of interest on the deposit increases. So our profitability or NII will be decreased by the amount of increase of deposit. Yes or no?
Yes, sir.
Yes, sir.
So,
Yes.
so that is the case. So such type of thing you can assess what is the position of liability or your cash outflow. So basically the liability position is that 100 crore deposit for 6 months with 5% interest is deployed in a term loan which has given for a 5-year period with 7% interest rate. So basically whenever there is a deposit interest risk rate rises, then only we will face a interest risk. That means our NII is going to go down that time. Okay, if during that period, because here 7% earning is fixed interest. Here 7% earning is fixed totally. Somebody's mic is on, please, some disturbance sound is coming. Can you please take care of that? So here this interest is not going to change because 7% is fixed for the 5-year period. So only changes that might happen in your liability side. So for that purpose, like this, you have ALM purposes. What happens? All the liabilities and assets are placed in different time buckets based on their repricing date. So here, this will be placed in a repricing date. That is, we know that after 6 months, this deposit is going to be repriced. It might, the rate of interest might change. So that is called the repricing date, when the interest rate is due for change. So the mismatch in each time bucket is measured as a gap between the rate sensitive asset and rate sensitive liability. We have done that. And this mismatch are measured either in the absolute term or as a sensitive ratio, whatever is possible. So basically, we will measure in absolute term and multiply with the assumed rate of interest and find out what is the impact on the NII. Okay, so if you can have that position, you may use some method to reduce the interest rate risk also. So how it is possible to reduce the interest rate risk? By swapping with float rate or fixed rate to floating rate, whatever is possible. You can use some derivatives to cover those things. So many methods can be used to cover this interest rate risk. Okay. Now, suppose you can do this problem easily. We have done that, so there is no problem here. So you can do this now. Here also, I have given you the gap. Gap is given. So minus 10 is gap because this is our rate sensitive liability. This is the rate sensitive asset. So gap is minus 10. Suppose rate of interest falls by 1% for both sides. What will be the rate of impact on our NII? Both sides falling 1%.
NII increases, sir.
NII
Increases.
Because our rate sensitive liabilities are more. So NII will increase. Okay. Now do the second thing. Instead of falling in same magnitude, let's say call money rate falls by 1%. Cash credit falls by 0.7%, savings fall by 0.5%, and FD falls by 0.4%. Already same kind of exercise we have done. Just to tell me what is the amount.
No, sir. Point 33.
Anybody else? Can you confirm that his 0.33 is correct?
Point 8, sir.
0.8. How?
Yes, sir.
0.8. How 0.8? Call money is decreased by what?
1%, sir.
So how much the amount is?
0.5, sir.
0.5. So that is a call money decrease. CC is decreased by how much?
0.7, sir.
0.7.
0.28.
So
0.28.
0.7 means 0.7% means you have 0.28. So call money reduced by 0.50, CC is reduced by 0.28. Means we have decrease in interest income by 0.78.
7.8.
Now we'll find how much is affecting our savings and fixed deposit. Fixed deposit
Fixed
is
0.25 decreases, sir.
savings is 0.25 and fixed is 0.20, right?
Yes, sir.
So 25 and 20 means 0.45. 0.45. So 0.45 we are saving.
Yes, sir.
And 0.78 our income is coming down. So
that's why NI decrease.
So 0.78 minus 0.45 is how much?
0.33.
0.33. So the NII would be declining by 0.33. Is it okay? NII declining, I told you. Have I told the right thing? NII is declining by 0.33.
Yes, sir.
You tell yes.
No, sir. Income.
What is the correct statement should be?
Sir, gap is
And I
negative
increased by
and rate
0.33,
also
sir.
decreasing. So it is positive.
Okay.
Gap is negative, rate also decreasing.
Okay.
So it will be
it is a
positive.
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 Okay. Are you clear with positive, negative thing?
Negative, sir.
See, that's why I told you, you should see whether it is coming down or coming up, because that positive say, rate of interest falling and you are multiplying with the cumulative gap, that minus 10 gap, that is only correct in case of when the interest rate is changing uniformly. I have told so many times. Uniform, suppose 1% change everywhere, then you can apply that one, or 2% everywhere fall or you apply that principle minus minus plus. But here it is in different magnitude. So what is happening here?
So here fall in asset is more than fall in liabilities.
Yes, that is what. So what will be the net impact on NII?
Decrease.
Decrease.
So NII is going to decrease. Here you have to see, because when why I am
our income is coming down. Sir, our income is coming down, and liability is there more because liability is on the higher side.
Simple take
inflow
that
is more decreased than the outflow decrease.
Simple thing, you write that your
So NI is negative.
Earlier NI was 100. Earlier NI was 100, whatever it was. Now this, due to this change, what has happened that our decrease in interest income has how much? Decrease in interest income has become how much? Minus
7.28. 0.78.
Say we take 78. Suppose I take 78. 78 income has decreased. So how much it has become?
99.
Okay, you take 0.78 and tell me how much it has come.
99.22.
99.22. Okay, now your savings of interest is by 0.45, right?
Yes, sir.
So add to that.
99.67.
90. So earlier your NIA was 100. Now your NIA is 99.67. That means 0.33 is a decrease of NII? Yes or no?
Yes,
So
sir.
when
Yes, sir. Yes, sir.
when such case 2 is given, always apply this 100 thing. 100 minus your 0.78 plus your 0.45. You will get the correct answer.
Thank you, sir.
Okay. Okay. So you think what was your NII earlier? How much you have decreased by in the income? How much have you saved due to that fall of rate of interest in the liability side? So you add that one. Finally, you get the figure. That will be the correct figure. That will, if that matches with your 0.33, then you are doing the correct thing. Okay?
Okay, sir.
Clear?
Thank you, sir.
Okay. Last one we'll do here. That's last one for today. This is about profit planning. Okay. How the profit planning of the bank can be done if such things are given. Simple thing. Here, this is a mix of your risk management and balance sheet management is there. Okay. Simply, suppose a bank has 4 options. Bank has 1400 rupees of fund available, and that fund can be used either in A, B or C or D. There are 4 options available how the funds can be utilized by the bank. So if the fund utilized by the bank is as per the A, that means that fund of whatever 1400 is there, bank is investing that fund in the Government of India securities, where 6% is the yield. Means return is expected on this Government of India security is 6% by the bank. And here risk weight of Government of India security is 0%. So when the risk weight is given, means definitely it is pointing towards calculation of capital. Okay. So here the things to be done. So in case of B, what is happening? In case of B, that's 400. That 1400 is deployed in 3 things. Bank has deployed the first 400 in the Government of India security, 600 bank has given loan to AAA rated corporate, and 400 is given as a retail lending. C is like this 4 or 5 categories they have given, and D is everywhere whatever the possible is they have deployed. Now we'll see how much the earning is there for this deployment and what is the capital bank has to be provided for. So difference between earning and capital will give us the retained profit for the bank. So which will be the best option for the bank to have more retained profit. Now tell me, what is the yield of this A? First calculate the yield of A. How much yield you are getting out of 1400 for a period of 1 year? How much it is?
84.
84. So first one is 84. Okay. This one is 84. There is no problem. Okay. And you see what is the capital you have to keep for that 1400?
0, sir.
0. So no capital is required because risk weight is 0, so no capital is required. So what is your retained earning here? It is 84 only. Your return earning, also retained earning is also 84. Okay. Now second one you do same thing. What is the total yield for these 3? How much it is coming?
$120.
120. Okay. Everybody is getting 120?
Yes, sir.
Okay, fine. Now calculate the capital for that.
Capital 400. $420.
72, sir.
No. How you are forgetting the capital formula? exposure multiplied by risk weight multiplied by 9%. Here it is written 9% is the capital adequacy ratio. Here I have written here. The first one, you do not calculate any capital because for first one, for A, B, C, D, it is government security, so 0 is the capital. Now you have to calculate for 600 and 400.
37.8.
37.8. Okay, fine. Write it down. 37.8 is the capital and 120 is the earning. So what is the written profit?
82.2.
82.2. Okay, fine. Do the third one. So much time you are taking. What is the total lead? You can use your brain to calculate. 300 into 80%, 408%, 410%, then your 312%, 112%. So simply 12, 36
That is 130.
plus
130.
130. Okay, fine. Now calculate the capital.
$83.25, sir.
Pardon, how much?
83.25.
Capital. No. I think you are doing something. Somewhere some error is there. Huh?
39.5.
How? Suppose you are having 3780, B's capital is 3780. So here another exposure is more here. So it cannot be. Somebody should give me the correct answer.
52.65, sir.
Pardon, how much?
52.65.
Yes, that is the correct one. 52.65 will be the correct one. So what will be the return profit? $77.35. Similarly, you calculate the D1 also. D column. Sudha not able to calculate. Why you are not able to calculate? Yield is given. Yield is the return on that asset. Mr. Harmit, can you please mute your mic? Some humming sound is coming. You please mute your mic and after you are done, you do it. Harmit, please. So, Sudha, see, here 6%, the yield are 6%. Yield is given. Yield is your return. So you calculate the return first. How much you are earning this? Just calculate the return of everything. Add all these things. That becomes your return. Then calculate the capital by applying the formula exposure multiplied by risk weight multiplied by 9%. Then only you will get it. Everybody is doing. So risk management, I have told you how to calculate the capital. So capital will be on 400 how much, 600 how much, 400 how much. So here the risk weight has been given. So this figure multiplied by applicable risk weight multiplied by 9 is the capital for this. So calculate for this. So all three you calculate, that is your total capital. Okay, so now everybody is calculating this D thing. So you have got one, how much? What is the total yield is coming?
134.
134. Satya Kamesh 154 is not correct. If yield is 134, I think. I also have done that. So it is coming as 134, not 154.
134, sir.
134. So you see 120 was the second one. We have got 120 here and 130 was here.
130.
130 was here. Then finally 134. Okay. So capital also similarly. Here capital was 3780. Here 5265.
63.9, sir. Capital.
63.9, sir.
63.9. Okay. Capital is 63.9. So return earning becomes how much?
70.1.
70.1. So you see that, this is the conclusion is that risk increases when the risk is increasing. So from here the risk in A portfolio, risk was 0%. In B portfolio, it is slightly increased because only 3 exposures are there. C again even slightly more increase, and D is the highest increase of risk. So whenever the risk is increasing, your yield is also increasing. Risk is increasing, so yield is also increasing. See, from 84 to 134, it is gradually increasing. That means it proves that when you enter into higher risk, your returns are also going to rise also. Okay, but you see the capital requirement. So when you enter into capital, when you enter into high risk, your capital increases. So earlier it was 0, it came to 3780, then it came to 52 something, now it is 63 something. So your need of capital is also increasing when the risk is becoming more high. So in such cases, you will see that the retained profit is reduced proportionately as your capital requirement becoming higher. Here only we have taken the funded exposure. We have not considered any non-funded exposure here. So if non-funded exposures or NPAs of the bank are concerned, are taken, that has to be also calculated for profit planning. NPA do not give us anything. We have to make provision for that. That amount of provision has to be reduced from the retained profit. And so that's why here how to make the profit more is the concern for the LM department. So they will look into this. They will see that how the credit risk can be lowered, how the interest rate can be managed to get the maximum rate of interest, because capital is a thing you cannot touch it. Capital has to be provided because simultaneously when you are entering into high risk areas, you have to provide for high capital. So the main concept is that you have to enter into some other businesses like increasing your non-interest incomes or increasing your fee-based income, which might take you to a better position to get better profit. So this way the profit planning are done. So sometimes questions are asked on this type of question will ask. So they will say that what is your total yield of this and what is the capital requirement, what will be the retained profit, you see, and which year it is there. So that way you can do it. If you can calculate all these things, then you can do it. Okay.
Sir, what is the average yield, sir? Yield percentage in this?
No, that is not required because average yield is not required here. Only see average yield can be calculated here. This is only one. So you can calculate that average yield is how much. So there are three different things are there. What is the average yield? So on this average yield will be how much? So 84 average yield, how much it is coming? 1484, 6% simply. Okay. Now average yield is 122,1400. What is the amount of, what is the percentage? What is the average yield coming? You calculate, it takes hardly 10 seconds here. You are taking so much time.
8.57.
So average is 120 divided by 1400 into 100. So 8.57.
8.57.
So 130 means how much? 130 divided by 1400 into 100. So it is 9.2%. 9.28. So finally 134 divided by 1400 into 100. So here 9.57. So your average yield is increasing because you are entering into more risk region. So when you enter in that, the average yield is also increasing. So that is not required. You got my average yield or not?
Yes, sir. Thank you, sir.
Yes, sir.
Okay, see you then tomorrow.